Alibaba is now down over 75% from its highs, and the share price reflects approximately 40% of cash on the balance sheet. And so the question is the share price telling us something about the future health and longevity of this company? In one word, no. And in this video, I'm going to explain what the valuation tells us and what sort of options opportunities are available with this name. But first, let me run that intro. What's up, guys, and let's dive right into this one. So you can see that Alibaba is now down 75% from its highs. It was trading above $300 per share in as early as 2020, and now it's just all the way down to under $100 per share, something that a lot of us investors never expected. And I'm not going to make you guys wait until the end of the video. This is my Alibaba valuation. Now notice that this is my free cash flow per share valuation that is net of the forecasted stock-based compensation that I expect this company to have over the foreseeable future. And so when you compare that to the current share price of approximately 80 bucks a share, this company's trading at a third of its intrinsic value, and that's using a low terminal multiple of 20 times earnings. And so what that really means is this business is selling for substantially less than its liquidation value. This is insane value territory right now. And what it really spells to me is that I'm going to be looking to triple down on this opportunity. Look, Alibaba is a small percentage of my portfolio, and I'm going to maintain that percentage as the portfolio grows by continuing to increase that position just so that it maintains that certain percentage of my portfolio as a whole. And so it's just getting cheaper for me in this environment. I'm a net buyer for the foreseeable future. I do see that as long as Chinese citizens continue to eat, sleep, and go to the grocery store, Alibaba is going to be a substantial value to them. And you're getting all those other businesses, the cloud business, the delivery business, the logistics arm, the Southeast Asia business for free in this environment. Now, you can see here that total China commerce still represents a significant amount of the company's overall revenues. Now, I do expect total China commerce to go backwards by approximately 7.5% in fiscal year 2023, and I expect overall revenues to go backwards by 5%. Part of that is that I expect digital media and entertainment to go back by 15%. So we'll see how fiscal year 2023 plays out, but I do expect revenue to go backwards because the economy is tough right now. But looking into the future, despite the ongoing challenges in China, it's hard to see Alibaba not growing revenues at a rate of 10% a year. And so into 2024 and beyond, I do expect revenue growth to return. Now, look, the beauty of the current valuation is that revenue doesn't necessarily even have to grow for this company to still be a value. Now, look, the cloud business provides the most optionality here. Cloud is, I'm only forecasting it to grow at approximately 15% a year. China expects their cloud business to grow at an overall rate of 30% a year. So that's half the growth rate that China as a whole's cloud business is growing at. And note, guys, that Alibaba's cloud business is now diversifying globally. And so you're going to see an uptick in revenue from the relationships that they link as this business continues to grow out. And in the next video, or in a couple of videos coming from now, I'm going to explain further how they're growing out that cloud business in detail. And you can see from here that they do have optionality to increase their adjusted EBITDA, because notice that this still is just a one-trick pony business where China Commerce has an adjusted EBITDA margin of 30%, but their overall adjusted EBITDA margin drops to 21% because they're taking losses in their other business segments. And so if they reduce investments into those other business segments, this company becomes immensely more profitable. But they're not going to do that because the hope is that over the next 15, 20 years, these segments start producing positive adjusted EBITDA amounts. And I would say that the hope is that these businesses start producing positive EBITDA amounts, not just over the next 15 or 20 years, but over the next 5 or 10 years. And so I'm being insanely pessimistic by not forecasting positive adjusted EBITDA for any of these segments except for the cloud business, where you can see that I'm forecasting a 10% adjusted EBITDA margin into 2032. So in other words, what I'm saying is that there's a huge amount of upside, not only on my revenue forecast, but also on my adjusted EBITDA forecast for Alibaba. if things turn around, which they absolutely could, you could see this valuation skyrocketing past $200 per share, because they're going to appropriately value what these segments could generate in the future in free cash flow. Now let's look at the call options, or at least the covered call options for January 19, 2024. Now, since I already have sold a $100 cash secured put stake for $30 per share, which gives me a net cost basis of $70 per share, I want a cost basis of $50 per share for the next opportunity. So I would love to buy the $75 per share security and sell a covered call at $25 per share, which would, one, reflect a 25% total yield, but two, it would reflect a $50 per share net purchase price. So right now that doesn't exist, but that's what I'm going to be looking out for when I triple down on this opportunity. Now, I just want to walk through some of the opportunities here. So the $70 cash secured put, although it is under the current share price, which is around $75 per share right now, the premium yield is 23% and the total yield is 15%. So that's not a bad investment. If you were to buy what the market is offering right now on a covered call opportunity, I would go after the $80 strike, which gives you an 18.5% premium yield and a total yield of 21%, because you get that capital gain capture from around $75 per share to $80 per share. Now, the $90 per share covered call would give you a lower premium yield, of course, because you get a lower premium amount, but a higher total yield because you get a higher potential capital gain. And so if you want to go all the way to 120 and you say, okay, well, I believe that this company could be trading at around $120 per share by January 19, 2024 or higher, but I do want some return right now. You can get a premium yield of 7.3%, but still leave yourself open to a total yield of 48.4%. If you're thinking along those lines, I would say just buy the stock and don't sell a covered call, because you always give away that opportunity cost. You know, who knows? You could buy it at $70 per share or $75 per share right now, and it could run to $200. So you'd want to capture that full amount. So I would do that. But the only reason why I would sell a covered call in this environment is for someone like myself who already owns shares and I just want to bring my cost basis down. And so the best way to bring my cost basis down would be to buy the shares at $70 per share, sell that covered call for $25 per share. And look, if it doesn't run, I don't care, because I will have reduced my cost basis down to $50 per share. And look, if it does run and I do lose those shares, well, at least I got that $25 per share in premium, which allowed me to reduce my cost basis on the shares that I already own. And hell, if it goes down even further, like $60 a share, I might actually just decide to buy the shares and hold them outright. I haven't really decided what I want to do with the position right now, but that's kind of what I'm thinking about. Now, looking at the 2025s, notice that they're not really that exciting. Now, the 75s do give you a 14.4% annualized yield and the total return is 13%. That's just not enough to hold it. The $90 just doesn't give you a high enough premium yield. And I would say that the 120s, you're probably better off just buying the shares and holding them outright and not giving up that opportunity cost. And looking at the cash secured puts for January 19, 2024, notice that the $70 cash secured puts have a yield of 13.1%. So not that exceptional. The $80 have a yield of 16.2%. So that's not bad. The 80 minus the 17 is a net purchase price of $63. So that's not bad, but I'm looking for $50. So it just doesn't make sense to me. The remainder of these don't really make that much sense to me. And you guys already know that I've already sold that $100 cash secured put at $30 per share. So it doesn't make sense for me to sell it again. I'm really looking for a substantially lower net purchase price, which is at $50. The cash secured puts aren't doing it for me right now, but the potential of buying the shares at $75 per share and selling the covered call at $25 per share makes a lot of sense for me. Or the other opportunity might just be if the shares go low enough to just buy the shares and hold them outright. Another opportunity could be to just buy call options in this environment. So that gives you huge optionality on the uptake that you would take, because you just get that natural leverage amount. So that's another opportunity here. But like I always say, the best thing that you can do is just buy low and sell high. So just buy the shares when they're lower. They're trading at 30% of their intrinsic value right now. So just buy the shares and just hold them until this company recovers. Now, it's never investment advice. Always seek an investment advisor if you're not sure. Now, one thing that I got to remind you guys is approximately 80% of the watch time on this channel is coming from people that are not subscribed. So please, if you have the opportunity, consider subscribing to the channel. And And if you want access to that Alibaba model and all the other models that the Patreons get access to, you can get access to all of those models by being a part of our Patreon. And another opportunity that seems to be pretty cheap in this environment right now is Meta. And so if you haven't seen my videos on Meta, you can get access to those right here.